Hello and welcome to Market Psychology 101, where we look for value in the markets when there's fear and are cautious when there's greed. In today's video, we're going to be taking a look at the stock market, the S&P 500, other indicators having to do with the stock market, and the Magnificent Seven stocks. Let's start off with fear and greed. And in CNN, we were recently right at the border of extreme greed. Now have pulled back just a little bit. On pie vesting, we were also in extreme greed above that 75 line and getting back down just into high greed, if you will. And going over to a couple other important charts to just keep in the back of your mind, seasonality wise, I hope you guys can see that at the bottom, that October to November, especially late October in election years, on average, seasonality wise, we tend to have this dip near the end of the month. So just something to watch out for. We're going to take a look at the VIX. The last I checked, the floor of the VIX, it was making some higher lows. So the volatility is slowly creeping up. Don't be surprised if there's any healthy pullback, something like 3 to 5% in the market sometime soon. Something to keep in the back of your mind is that the Fed did cut rates in September. They cut by 50 basis points. And what's really important to pay attention to is how much is the Fed going to or not going to cut in November. They did not have a meeting, or they're not going to have a meeting unless it's an emergency meeting in October. So really, yes, the last couple times there are 50 basis point cuts. The stock market has not had good returns in the near term future. But what's important to know is the Fed cutting large and fast or low and slow? So the way I'm interpreting it is that even though they started with 50, let's try to not focus on the number, but more the average. If they're not cutting in October, those are two 25 basis point cuts. Inflation's come down. I can show you that on the chart. Unemployment went down a little bit. We'll see if that trend continues. If it does, then I would doubt that they continue to cut by larger than 25 basis points, but you never know. There was a chart I saw, and I didn't attach it to the video, so I apologize, but it was showing the pie chart for the government's budget next year, and I believe that the U.S. budget, the interest payments, because the rates are so high, around 5%, that the interest payments on our national debt is even slightly higher than the defense bill. I believe it was the third highest payment in the budget. So something to just watch for macro-wise. I'm sure you've seen other videos going around on YouTube or people talking about it on X that the deficit is a problem. It is a problem, but not yet. It won't become a major problem until there's a black swan event or some sort of catalyst when the debt is owed. So anyways, we'll see what happens in November. If the job numbers aren't good, we'll see what the Fed does. I'm really curious to find out. So November's Fed rate cut, in my opinion, more important than what they did in September. And also, I've made this statement before that on average, the vertical line when the Fed cuts rates, there's two ways we typically go, higher or lower. September, we continued into all-time highs. And usually September is negative for the market. So with that being said, I read a couple articles out there on the internet. And again, sorry I didn't paste them in here, but basically what they said is that when there is new all-time highs during the month of September, that quarter four has always been good. And I think the one exception was 1987. It was like late August or something. But otherwise, when September is still all-time high territory, Q4 tends to still be bullish. And we had this 10% sell-off before the rate cut. This was the end carry trade unwind, as some of you may remember when the VIX spiked. So right now we're in all-time high territory, and we could still continue this way for another year. So again, I've been making the argument that we're in somewhat of a 1998 scenario with the AI bubble instead of the dot-com bubble. However, inflation's still a factor, and I wanted to take a look at the charts for that as well, going back in time. Let's just talk briefly about crypto. Crypto still up in the high greed area, got up to 73, slowly coming down. As far as the overall larger trend, still lower highs. Okay, yes, we've had some recent higher lows, but I want to see it break above this 75 number to see, is there confirmation Bitcoin's going to the upside? If Bitcoin starts getting above 70K pretty soon, I think this will confirm a higher high from this point in July. So let's get into the stock market. So as I told you guys, during the month of September, there were new all-time highs being made. Here's September. So new all-time highs from before, continuing that new all-time high trend. And again, you can look for this online yourself. When new all-time highs are made in September, Q4 overall is bullish. I think the one exception was 1987. So last couple pullbacks, I like to take a look at the moving averages and see where are the moving averages that the whatever asset, stock, crypto is in love with. And you can see, likes the 20-day moving average. Sometimes it comes down to the 100 when the pullback is usually a bit bigger. So the 100 moving average, if we were to get somewhat of a decent pullback around 55.64, and if there is any sort of seasonality, as I showed you in the election chart, late into October, before the November election, something like a 3 to 5% pullback. Well, look at that. 3% would put us at the 50-day moving average, and 5% would be at the 100-day moving average. So if we do get a little volatility, don't be surprised if we see something like that. Let's zoom out a little bit. So I've made the argument that we're in a 1998 style scenario. Let's zoom out a little bit here. So this was the dot-com bubble, great financial crisis. These were the rate cuts when they did large and fast. Okay, the 50 basis point rate cuts that you saw before. 1998, when they cut by 25, and they only cut a couple times before pausing, then the markets went up a bit more. So after that first cut, no, I'm not drawing it perfectly here. The stock market still went up about 50%. And should the stock market, if it were to go up another 50% from that rate cut, I'm just kind of curious to see what that would be around. 50%, my God. Okay, it'd be off the charts. So I don't think something like that's going to happen. Again, that's a unique situation we had there. But since the great financial crisis, you can see here we've been in this ascending channel, never getting higher than this area and only getting down to the lower end of the channel here in COVID. So as far as price targets within this channel, I'm just going by the last couple points here. As far as highs, we could be looking at something from the low 6,000s to the high 6,000s, going back over to the 60s and the 70s. So well, there's a lot of comparisons between the late 60s to the early 80s because the spikes in inflation. And as you guys can see here, that by the way, the white vertical lines, those were the highs in inflation. Okay, we had 3 highs in inflation. The red lines, that's when the Fed is cutting after holding. Okay, so the red lines you can see kind of coincided with the height of inflation. What a time that must have been. And they were cutting again before inflation peaked here. Again, it's the first cut in what they did. So as far as any similarity in the markets back here, just sort of eyeballing this here, but a thought I have is, there's a lot of recency bias. Again, market psychology. I want to give you guys different psychological things to ponder or think about. Last week, I talked a little bit about self-fulfilling prophecies. We want to be careful of our biases and just hearing the same thoughts, the same things so much. The way YouTube, X works, the algorithms work is that it sort of puts us in an echo chamber that we are going to hear the things that we like over and over again. It just creates these self-fulfilling prophecies, and then we get really locked in and convinced on our own ideas. And I think it's good to think outside the box. So one of those self-fulfilling prophecies that I've been kind of talking about is believing we're in a 1998 scenario. And so I stopped myself and I said, what would be an alternative to that? Because I'm starting to lock in a little heavy on this 98 scenario. What would be an alternative? Well, there's no one denying that inflation has been a recent problem. And with inflation being a recent problem, let's go back to the 60s, the 70s, late 60s, the 70s, the early 80s. Does this resemble any bit of the market that we have today? And looking at this, I can't help but feel or think that, we are experiencing something similar right here as we are today. So you can take, this bottom that we had in October of 66. Let's measure this out. So from the peak here to the bottom, there was a 24% sell-off. Again, late 22. This is what I want you guys to think of. Late 22, about a 25% sell-off. And then markets ran higher by about 50%. And so just this pattern, or fractal, if you will, sort of reminds me of what's gone on down here, that we had that correction, and I believe it was bigger than 26%, okay? And that we are having that 50% pump to the upside. We're already up 60%. So I was just taking a look in the 60s and 70s, and I said, you know what? What if inflation does become a problem? What if the Fed did cut too soon and inflation comes back? I don't know, but it's something to consider. Let's take a look at inflation rates. So inflation, let's take a look at inflation rates. And I know there's some differences in how they track the data from the past compared to now. But those three spikes I'm talking about that we had here, a lot of people are saying this recent spike we had because all the money printing, the trillions that were printed out of thin air for stimulus money post-COVID, that this was more similar to what we experienced, and maybe we have another bigger one coming. And you can see that inflation, it did come down all the way to 5%. Now watch these moving averages. It really never got underneath those moving averages either. I do think that's helpful. The first inflation spike got up to 6%, got down to 2.7%. And where are we at today? So recently the inflation, they had it measured up to 9%, and it's getting down towards 2% again. So you guys can see there is a base here, got underneath the moving average. That's a good thing. You don't want deflation. Disinflation's fine, but deflation can be a bad spiral. Again, I don't want to get too much into the weeds here, but the Fed has this target, this red line, around 2%. Okay, let's take a look at U.S. interest rates. That's the other thing I wanted to talk to you guys about. So 1998, it's what I've been talking about here. Okay, that I believe we still have a year, up to 2 years of upstyle market before things roll over. Let's go back to the 60s. Okay, let's go back to the late 60s. Whoop. Sorry, I scrolled too fast in there. So they tracked this back to, well, they only tracked it back to the 70s, but that's fine. You guys can see here that they raise rates. Can you imagine? 13%. It wouldn't be so bad if the debt wasn't so large, and then came down to the base of what they brought it to is 4.7. So very different time. I believe my parents, they got a house somewhere in here, and I remember asking them about their rates, and I was like, really? That's like twice as much as what I have for my current house. But can you imagine getting a house at 20%? Inflation was going up, rates were going up. Had to have been a really difficult time to buy a house. So guys, I don't know if another inflation spike is going to happen. It's important to look at these charts once in a while, just have somewhat of a feel of the macro data that's coming along. But again, if we are comparing to the 60s, late 60s, and the 70s, I do think it's important to watch how the market reacts and if there are more similarities that come in from this time to now. Okay, talked about that for 14 minutes. My God. Let's get moving here. My apologies. So let's go over to the VIX. This is the volatility index. Some of you guys are patiently waiting for the Mag 7 stock analysis. I'll get there. You can see the volatility moving its way on up. This was a recent volatility spike. So increased volatility. We have a buy signal here on the daily. So volatility, again, it could time out perfectly. Late October, early November volatility spike before the election. Another thing to keep in mind is the percent of stocks above the daily 200 moving average. Look at this wick here, up to 73%. I talked about how when this gets to the 70%, then it typically comes back. Wicked up there. That's really unusual, by the way, as far as going back. We don't see that big of wicks too often. So uh, whatever happened 5 days ago, I think that's when Nvidia was going up to 240 or 140, I believe. You can see a little bit of selling and a little bit of a bounce here down on the 200. This is 200-day moving average. So we'll see if the percent of stocks above the 200-day moving average continues to move down. And if it did, you can see there's a little range here that it's come to before. And also, we talk about this time to time, yield curve uninversion. Typically in the past, a couple times when the yield curve has uninverted, the red lines are where the vertical red lines are where the bottoms of the market are. And that's typically been a year or two later. So we just had the uninversion here. So is a market bottom coming a year and a half, 2 years later? The uninversion of the yield curve, that's when you start the clock. So anything I talk about here with especially the larger stocks, do not be surprised if in a couple of years we are getting 30 to 60% discounts on your favorite stocks. Again, unemployment rate, this is something to keep in mind. I believe it's better on a log scale. There we go. Had a little bit of a tick down. You guys saw with inflation tick down. Again, we're talking about the macro data here because this affects everything, crypto included. And should the next unemployment rate data come down or stay down low here, and should inflation stay low, it would be surprising to me if the Fed was going to continue cutting by 50 basis points. If they did another 25 once or twice, okay, I get it. Maybe they're doing it because they can't handle the interest payment on the debt. And maybe that is a problem that isn't being addressed enough. Politics aside, I'll say this. I'm an equal opportunity hater. As a psychologist, I try to question everything, and sadly, as I've helped people for the last decade in the field of psychology, I try to look for flaws in people's arguments. The political system, the two-party system, it's become more of a religious cult for many people than it is something that can be openly debated. And both parties, there's no argument, are spending more than the amount they are receiving. So debt is becoming a problem. Fiscal conservatism has been gone for a while, and that is going to grow into an issue. And one of the ways that you'll see people talking about now, you've probably heard the buzzwords that the market's melting up or hyperinflation. Maybe you've heard that term. Basically, what people are talking about is that should debt really be a problem, that the government would try to create more inflation in order to pay down older debts. So the older debt wouldn't be as bad with more inflation, if that makes sense. So if you have a hard time paying off a debt of $100 and all of a sudden you create more inflation to where that $100 isn't worth as much, then you can more easily pay it off. That's one argument going on out there. Again, I think it's too early to really tell. We'll see. And I think keeping track of the unemployment as well as the inflation rate and the yield curve, those are the most important things right there. All right, 19 minutes. Let's get through these Mag 7 stocks as quick as we can. So you can see here, NVIDIA, let's go to the daily. Still punching through. Whoa, created a new all-time high. You go, NVIDIA. So had a new all-time high. You guys can see here when it comes down, has come down to the 100-day moving average. And if there is any sort of a pullback, maybe you can look at the 50-day moving average or the 236, somewhere around 124. That might be a healthy area to pull back. Again, the 100 days coming up, even something in the high 100 teens wouldn't be so bad. Would I buy NVIDIA here? Heck no. Again, if we're talking about possibly having a recession, again, I'm going to keep talking about this. Some of these stocks, don't be surprised if you see anywhere between a 30% discount, which would put NVIDIA around 100, to a 50, 60% discount. I know it seems hard to believe. And again, that'd be NVIDIA around 50 to $70. Okay, I know it seems crazy now. Seen this happen in the dot-com crash and great financial crisis. Who knows how big of a pullback the stock market would get in an upcoming recession, whether it's one of those big 50 percenters or maybe only a 25 to 30 percenter sort of reaction. But we have indicators we look at. We have the fibs, we have the buy sell signals, these dots that I recommend looking at on the weekly and the monthly, okay? And we have the moving averages, the stochastic RSI. Plenty of good things to look at. So Microsoft, you can see here that Microsoft could bounce off the 200-day moving average. We've been talking about this, how Microsoft, when it's at the 200-day, that is more of a rare moving average for it to get to. Yes, it's broken under there before, and it's the 200 days kind of close to the 50-week. And the 50-week is the dividing line between calling something bullish and bearish, typically. So weekly buy signal coming off that 200-day moving average and the 50-week moving average, or close to it. So if you really love Microsoft and you're a dollar cost averager, okay, there you go. One of the best stocks in the world, if not the best stock. Apple continuing around that all-time high area. You can see this is the 1618 fib, which is right at about, scroll down here, 233. So Apple around that 230 area. Are people taking profits? It's only wicking above. If it does come back down, be ready. It is possible. Sometimes we see stocks, cryptos, they get up to these fib extensions and weaken off, but so far it's still in a buy signal from this doji candle here. Amazon had a good bounce off the 100-week moving average, had a wick there, candle body to the 50. Again, it's at that all-time high area. Struggling with that. It has been smacking this so many times. So 1, 2, 3, 4, 5, going back 6. You know, the first time the all-time high was created. So Amazon struggling here at this all-time high area around 190. So is it getting ready to finally go through? Hopefully. Google, and again, I wouldn't buy any of these stocks outside of Microsoft from a dollar cost average strategy, just because where it's at. Google, you can see sell signal on the weekly playing out right now. So this so far looks like, if we ignore this here, a 3-wave pattern. Again, I'm not an Elliott wave analyst whatsoever, so don't trust me on that. But if it is a 3-wave pattern, you know, maybe it's going to come down to the 100-week moving average somewhere around 137. But you can see, you know, I'll say again, I look for what moving average has a stock, crypto, asset been in love with the most, that deeper value, and that's the 50-week moving average. So if the sell signal holds true and pattern remains consistent, maybe it's just the 50-week around 156. If you get a weekly buy signal around this 150s area, I don't hate it. As far as Meta got up to the 1618, peaked above it, right around 600, sell signal. So again, what moving average does Meta love? It loves the 20-week moving average. And so if Meta, after a sell signal, gets a good bounce off the 20-week moving average, somewhere around 530, that'd be good. But if it got deeper, that would be rare because it hasn't done it in a while, at least since this uptrend started. Lastly, let's take a look at Tesla. I am flying through these. Hope you guys are proud. Trying to talk less. Sometimes I can't help it. There won't be, by the way, a live video this week, but I'll do one next week. So got some plans. Apologize for that. So anyways, Tesla, it's been in this channel, if you will. This channel sucks as far as how I drew this. I never got good grades in art class when I was a kid. I apologize. That is better. So closer to the lows here. You can see when Tesla came down to the lower end of that channel, what happened? Got a great buy signal. So Tesla, Microsoft, Google would be the better looking Mag 7 stocks. Let's go. Holy crap. Yeah, something's going on here. So Tesla, look at that daily candle. My God. So Tesla, it is a $832 billion company. What move was this? Jesus. 20%. That is crazy. So just imagine, guys, 20% of $830 billion. You know, if we just thought 25%, that would be around 200 billion. You know, so a little bit under that. So I don't know, 150, 200 billion. Am I doing that right? That that's crazy. So what a candle that was. I have to take a look at this on a smaller time frame. Holy crap. We don't see candles like this too often. So yeah, 17% here and then up to 22%. Wow. Okay. Good for you, Tesla. So Tesla in this channel came down to the lower end. And, something we talked about recently, and I've admitted recently in my videos, I know I have a bias against Tesla because it's an automotive company. Now, yes, there's more to it than just the car side of things. Elon's building robots, and the shocking thing to me about the robots he's talking about is the cost of them. Can people really get a robot that does anything around the house for 30, 40,000? I mean, he's promised a lot of things before. Talked about 1 million robo-taxis being on the road by 2020. That didn't happen. Now unveiled what the robo-taxis would look like. And again, I know it seems like a big deal, but guys, as someone who travels around the world, this type of technology already exists. Bullet trains, electric, automated taxis, it's already things in Europe and Japan. And so it kind of makes me laugh once in a while when people talk about these things with Tesla or whatever company. It's like America's a little bit behind on some of this infrastructure stuff. Just saying. But I did talk about how we had this giant wedge pattern, right? I've also talked about a while ago before how Tesla has had these deep value bounces off the 100-month moving average. I mean, man, Tesla's not for the faint of heart. But as far as this wedge, you notice what happened recently. Tesla came right down to the upper trend line of that wedge, as well as the 200-day moving average, got down to both, and the lower end of the channel, and boom. So there's a lot of good areas for support here. Again, lower end of the channel, 200-day moving average, this trend line from the wedge that it broke out of twice before. But a couple things to consider. This is a lower high. Okay, you guys can plainly see that. So the next thing you want is Tesla to get above 265 and then 271. So should it start doing that, then next thing you're going to look for is the 786 around 300, upper end of the channel around 340. Again, most of the time, it isn't just a straight wick up, goes in waves, but Tesla acting more like a crypto. So if you're in Tesla, good job. Not the stock for me, but I'm more of a degenerate that likes crypto and other things. So my advice that I give people when it comes to stocks, have it be something you like and use. And if you have a Tesla and you like it and their balance sheet is great, by the way, and you believe in it, invest in it, okay? I don't have to like it. If you do, good deep value areas in this channel and moving averages. So anyways, guys, hope you enjoyed the video. Hope you have a fantastic weekend. Gonna do some hiking, gonna do some fun things with friends and all that. So yeah, I'll miss you all on the live stream. Those have been fun lately. Have those a lot of Fridays, so it'd be good to have more of you guys join in. It's always good seeing your comments, especially in the live, asking questions about certain stocks or giving your thoughts and inputs. So yeah, let me know what you think in the comments below. So thanks for watching. Sorry the macro talk got a little bit longer than normal, but just I wanted the process with you guys, some of my thoughts, and also my own recency bias, and open our minds to other possibilities that we haven't been talking about as much. So thanks for watching. Take care.